Welcome to Iron Financial, the channel where we forge a stronger portfolio by stress testing the market's biggest names. Today, we're cracking open the latest earnings report from Bristol-Myers Squibb. Now, the stock is up, the headlines all look pretty good, and Wall Street is definitely cheering. But our job is to go deeper. We don't just read the report, we take a wrecking ball to it, because that's the only way to find out what's really going on. You know, on the surface, BMY beat Wall Street expectations for the fourth quarter. It looks like a solid performance. But any good builder knows you can't judge a skyscraper by the fancy paint job. Today, we're going to take a metaphorical sledgehammer to the drywall. We're going to see if the financial foundation here is truly solid or if this is just a coat of fresh paint over some really serious structural cracks.
Exactly. That's what we're here to do. We need to find out if this is a company that's truly built to last for the next decade, or if what we're looking at is a house of cards just waiting for a stiff breeze to knock it all down. So let's get into it. Let's dive in.
Okay, so let's start at the surface. Let's talk about the numbers everyone is cheering about. Before we start poking holes in this whole thing, I want you to lay out the headline figures for me. What exactly did they report that has everyone so excited? All right, the numbers are right here, and you got to admit, they are clean. Revenue came in at $12.5 billion. That's a solid, 2% beat over the consensus. That's nice, but it's not what moves a stock this big. The real power, the number that got all the trading algorithms firing, was on the bottom line. The adjusted earnings per share hit $1.26. Now, this absolutely crushed the street's estimate of $1.15. We're talking about a massive 9.3% beat. That's not just a nudge, that's a statement. So you look at it on paper, it's an undeniable win. These are the kinds of figures that create those positive headlines and get the momentum going. Okay, but let's just pump the brakes for a second. The market isn't a surprise party. As this slide makes painfully clear, the smart money, the big institutions, they saw this coming a mile away. The stock has rocketed up over 20% in just the last 3 months, leading into this report. So my question is, who are we kidding here? Was this great beat already baked into the price? Are we just celebrating old news? I need to know if there's a real structural shift happening inside this company that justifies not only the rally we've already seen, but future growth. Or are we just watching retail investors show up late to the party again? This right here is where the real analysis has to begin. That is the core question. You've hit on the central conflict, the civil war that's happening inside Bristol-Myers Squibb. And the answer lies in this massive rebuilding project that's going on within the company. I want you to think of it like this. They are actively demolishing a massive, aging part of their corporate structure, while at the same time trying to build a brand new, modern skyscraper right next to it. And they're trying to do it using the materials from the old building. The tension, the sheer stress of that operation, it's palpable in every single financial metric you look at. Now look at this chart. This visualizes the construction site perfectly. In the fourth quarter, the new growth portfolio, that's the new skyscraper they're building, it made up 59% of total revenue. That is a huge, huge milestone. It means the new building is now bigger than the old one. The legacy portfolio, that's the old structure they're tearing down, is now down to just 41%. Now, just a year ago, that split was much, much closer to 50-50. So this transition isn't just happening, it's happening fast. The company is fundamentally changing its entire composition right before our very eyes. The crossover point has been hit. And that new skyscraper, it's being built with high-grade reinforced steel. The growth portfolio revenue jumped a powerful 15% year over year. It hit $7.4 billion for the quarter. I mean, let that sink in for a moment. This isn't some theoretical, pipeline dream kind of growth. This is the new engine room of the company, and it is firing on all cylinders right now. Products you hear about, like Opstivo, Reblozyl, Camzyos, they aren't just contributing anymore. They are becoming the new load-bearing walls for the entire enterprise. This, right here, is the core of the bull thesis for this company. That's a great story. It really is. But let's be absolutely clear about the demolition work that's happening on the other side of the lot. You can't just ignore the wrecking ball. For every new beam they're putting up, a massive chunk of the old foundation is being pulverized into dust. As you can see on this table, for every exciting growth driver like Camzyos surging an incredible 57%, you have an absolute anchor like the former blockbuster Revlimid, which plummeted 55% in a single year. Now, for the full year, the legacy portfolio lost about $4 billion in revenue. The growth portfolio, it almost offset that. It grew by nearly the same amount, but not quite. This isn't just a transition. It's a desperate race against time. They're trying to build faster than the old structure is collapsing. Exactly. The Market Skeptic is absolutely right to frame it as a race. This slide here, it sums up the entire corporate strategy. It is a high-wire act.
They are balancing between building these new durable revenue streams and managing the controlled demolition of the old ones. So the single most important question for any investor, the question that everything hinges on, is about the biggest, most critical pillar in that old structure, Eliquis. It's their single largest drug, and for the longest time, it was supposed to be their single biggest problem.
Right, Eliquis. For the last year, this drug has been the dark cloud hanging over the stock. It is their biggest drug by a very wide margin, and everyone on Wall Street, and I mean everyone, was braced for this thing to start crumbling. It's facing pricing pressure from Medicare negotiations, and the patent cliff is just looming on the horizon. This should be the single biggest weak point in the entire foundation. This is where the first cracks were supposed to appear.
And that's where management pulled an absolute rabbit out of a hat. This is the number that changed everything. The entire market, every analyst, every hedge fund, every model was projecting a decline for Eliquis starting in 2026 because of those Medicare price negotiations. It was the central pillar of every single bear case against this stock. Instead of guiding down, management came out and projected 10 to 15% growth. Let me repeat that. Growth. This wasn't just a beat. This was a fundamental shattering of the entire consensus narrative. This single number, more than the entire Q4 report, is what reset the game and sent analysts scrambling back to their desks to rebuild their models from scratch.
Okay, hold on. How is that even possible? They're telling us they're cutting the price of their biggest drug, but they expect revenue to go up? That completely defies basic economics. That sounds like the kind of management spin you hear when a company is in serious trouble. It feels like they're trying to mask a huge problem with complex accounting jargon. I'm just not buying it without a serious explanation of how this magic trick works.
It's not spin, and it's not a magic trick. It's a calculated and, frankly, a brilliant piece of financial engineering. It's designed to navigate the new rules of the Inflation Reduction Act. This slide breaks it all down. So first, they strategically cut the list price, what's known in the industry as the wholesale acquisition cost, or WAC, by about 40%. Now, here is the genius of the move. Step 2. By proactively cutting the price themselves, they avoid a government rule that would have forced them to pay massive, punitive rebates back to Medicare. Why? For raising prices faster than inflation in prior years. Those penalties were like a ticking time bomb just set to detonate on their revenue stream. So step 3, this move secures favorable access for patients on Medicare, which allows BMY to maintain and even grow its dominant market share. And then finally, step 4, it all comes down to the math. The math works out so that the higher volume of prescriptions they'll secure more than offsets the lower price per script. They basically turned a massive headwind into a tailwind for 2026.
So it's a temporary fix. It's a clever patch job, I'll give them that, but it is a patch job nonetheless. They're telling us right now, in the very same breath, that in 2027, this pillar develops a massive crack as European patents expire. They are guiding for a $1.5 to $2 billion revenue decline in a single year. That's a huge number. So this move doesn't solve the long-term patent cliff problem, it just buys them one more year. So the real question, the multi-billion-dollar question is, what are they doing with that extra time? And is it enough?
They're using it to pour the concrete for the new foundation. You can't build a skyscraper overnight. This clever strategy bought them a crucial 12 to 24 months, and they are using every second of that time to focus on two things: bringing new, powerful products out of their pipeline and reinforcing the entire company with extreme cost discipline to fund those new launches. This is the point where execution becomes absolutely everything.
First, let's look at the pipeline. This right here is the blueprint for the next phase of construction. This slide lists 6 potential new products that have pivotal, late-stage data expected this year alone. So this isn't a single bet on one drug. It's a diversified portfolio of shots on goal. You've got Milvexian in cardiology, which they hope is going to be a successor to Eliquis, and then they're making a huge push in oncology with their CellMod platform. That's a whole new class of oral drugs designed to attack cancer in a novel way, and that includes potential blockbusters like iberdomide and mezigdomide. Any one of these succeeding could be a multi-billion-dollar product. Yeah, but a pipeline is just a blueprint, let's be real. It's a list of promising ideas on paper, not actual revenue-generating steel beams that can hold up a company. Clinical trials fail all the time, especially in the late stages, when the stakes are highest. The heavy lifting that's required to turn these assets from a slide presentation into multi-billion-dollar blockbusters is immense, and success is never, ever guaranteed. This is still a very high-risk phase, no matter how good the blueprint looks. Which is precisely why they are reinforcing the financial scaffolding around the entire project. See, they aren't just betting on the science, they're betting on discipline. Look at this number. They delivered a full $1 billion in operational cost savings in 2025. That is not a projection. That's cash in the bank. And $1 billion in this industry, that's enough to fund a massive clinical trial or to completely outmarket a competitor at launch. This is the fuel for the construction project, and it proves to me that management is deadly serious about execution. And they are not done. They've put the market on notice that they are targeting another $1 billion in savings over the next 2 years. So this isn't a company that's just sitting back and hoping the pipeline works out. They are running a lean, focused, and frankly, a ruthless operation. Management is sending a clear signal to Wall Street. Every single ounce of fat from the legacy business is being cut to build the financial muscle they need to launch these new drugs and fight off the competition. This is how you de-risk a pipeline. Okay, fine. Let's put this new structure under a proper stress test then. The blueprint looks promising, I'll give you that, and the construction crew is obviously working hard. But a building can look great from the outside while it's hiding major issues in the foundation, and I see a few potential cracks that we need to examine very, very closely. First off, and this is a big one for any long-term investor, look at the gross margin. As this chart shows, it dropped a significant 210 basis points in just 1 year. It went from 74% down to 71.9%. Now, the company blames product mix, which is just a corporate euphemism for the fact that their new skyscraper is being built with less profitable materials than the old one. Lower margin products are making up a bigger piece of the pie, while those extremely high margin drugs like Revlimid are disappearing. This is a structural headwind. It means the company has to sell more and more just to make the same amount of profit. That is a slow, grinding crack in the foundation. Those are the undeniable risks, and any serious analysis has to acknowledge them. You can't ignore them. As this slide shows, that 2027 Eliquis cliff isn't a possibility. It is a certainty that has been guided by management themselves. The rest of the legacy portfolio will continue to decay, probably at a rate of 12 to 16% this year alone. And even if their pipeline drugs do succeed, they're going to launch into fiercely competitive markets in oncology and immunology. So you're right, there is absolutely no margin for error here. And that brings us to the final verdict. So we've examined the blueprints, we've walked the construction site, and we have stress-tested the foundation. So the question is Bristol-Myers Squibb building a fortress for the next decade, a structure that can withstand any storm?
Market skeptic? Or is this whole thing a flashy facade with a fatal design flaw that the market, in its excitement, is currently ignoring?
Our verdict is this. The rebuilding is real, the strategy is sound, and so far, the execution has been absolutely brilliant. This is not a value trap. The growth portfolio is a powerful engine, it's legitimate, and that Eliquis strategy was nothing short of a masterstroke that neutralized the single biggest threat to the company. The bull case is intact.
But let's be crystal clear. This is not a finished fortress. It's an active, high-stakes construction site. And the market, with its 20% rally, has already priced in the successful completion of the first few floors. You could argue the easy money has been made. From here on out, management has to deliver the rest of this skyscraper perfectly, on time and on budget, with absolutely zero room for error. The risk has now shifted from strategy to pure execution.
So the question for your portfolio is this. Are you investing in a blueprint, or are you investing in a finished building? Bristol-Myers Squibb has proven the blueprint is solid. Now the really heavy lifting begins. For Iron Financial, I'm the lead analyst.
And on the Market Skeptic?
The foundation is definitely stronger than it was a year ago, but don't forget to keep your hard hat on. The work is far from over. Thanks for joining us.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do